1 year ago, President Trump signed the biggest tax cut bill in the history of America, and now your taxes are going to change in 2026. Take a listen. We have officially made the Trump tax cuts permanent. That is the largest tax cut in the history of our country, added to substantial other cuts, which is you are going to see like a rocket ship. We are setting all sorts of economic records right now, but this tax bill can only be great if it actually lowers your taxes. And as a licensed attorney who is not your attorney who keeps a copy of the federal income tax code in his office, I can tell you that the IRS is not going to tell you how much or how little you should pay in taxes. They let you figure that out. If you pay too much money in taxes, they do not say anything. But if you do not pay enough money in taxes, you get fined. Well, this new Trump tax bill, which is now going into effect, is about 1,000 pages long, and the media has covered some of the big changes. No tax on tips, no tax on overtime, and no tax on Social Security for our great seniors. But there are still probably other tax opportunities that you and your CPA might be missing. And that is why in this video, I want to go over 5 of some of the biggest tax opportunities through this tax bill that many people have overlooked. That way you can pay less money in taxes legally. Now, to lay the foundation so we are on the same page, let us start by talking about your income tax rates. Because if this tax bill did not go through, this is what your tax rates would have looked like, assuming that you were a single tax filer, and I rounded these numbers to keep them simple. If you were a single tax filer and you made between $0 and $12,000 a year, you would pay 10% of the money in taxes. For every dollar that you earn between $12,000 to $49,000, you would pay 15% of your money in taxes. For every dollar between $49,000 and $120,000, you would pay 25% of the money in taxes. Between $120,000 and $250,000, you would pay 28% of the money in taxes. Between $250,000 and $544,000, you would have paid 33% of your money in taxes. Between $544,000 and $546,000, you would have paid 35% of the money in taxes. And for every dollar above $546,000, you would have paid 39.6% of your money in taxes. But this new tax law changed these numbers completely, so let me now diagram what your tax brackets actually look like in 2026. Based off of this new Trump tax plan, under this new tax plan, we saw 2 things change. We saw the brackets change, and we saw the dollar amounts change as well. So for every dollar that you earn between $0 and $12,000, that is going to stay the same at 10%. Again, this is assuming that you are a single tax filer, and I rounded these numbers for simplicity. Now, the tax rate for the next tax bracket is at 12% up to $50,000 as opposed to $49,000. After that, it is a 22% instead of 25% at $105,000 instead of $120,000. Then it is 24% instead of 28% at a top dollar amount of $211,000 instead of $250,000. Then in the next bracket, you are going to pay 32% of your money in taxes for every dollar between $211,000 and $256,000 instead of $544,000. Then you are going to pay 35%, which is unchanged up to $640,000 as opposed to $546,000. And then your top tax rate is now 37% as opposed to 39.6% at a top dollar amount of $640,000 and above. The other part of the foundation that you want to understand is the changes in the standard deduction. This is the tax write-off that everybody qualifies for no matter what. And so in 2025, if you were a single tax filer, your standard deduction was $15,750. For married filing jointly, your standard deduction was $31,500. Again, everybody qualified for this. If this tax bill did not go through, the standard deduction would have changed. It would have gone to $8,350 for single tax filers and $16,700 for married filing jointly, which means yes, your standard deduction would have fallen significantly without this new tax bill, but now with this new tax bill, your standard deduction actually went up from 2025. Now, if you are a single tax filer in 2026, you will qualify for a $16,100 standard deduction. Everybody gets that. Or if you are married filing jointly, you will get a $32,200 standard deduction that everybody qualifies for with anything else. So this means that for the average person with these new tax bills and with this new standard deduction, the average person in America should be paying less money in taxes. Now, you might be wondering, well, why do we need a standard deduction? Why cannot we just have lower tax rates? That is a topic for a different video. It has to be complicated because that is how accountants and attorneys get to keep their jobs and the big salaries. But let us talk about now some of the other deductions, the other write-offs that you might be able to qualify for that could help reduce your taxes even more. Some of these are going to be less known than others. So let me break it down one by one. By the way, this is one of those reasons why it is so important for you to be an investor, because as you start to study the tax law, you will see that our tax system is designed to benefit investors while you pay a lot more as an employee. Why is that the case? Well, that is what the tax law says. And if you want to learn how to be an investor or be a better investor, I have a free investing masterclass that I put together. It is brand new where I will walk you through how you can get started as an investor and find hidden investment opportunities before they hit the headlines. I will show you the exact framework that my firm and I use to research investment opportunities and to find investment opportunities before the crowd hears about them. It is a free masterclass, and when you sign up for it, you are also going to get access to Market Briefs, which is my newsletter for investors completely for free. So if you want to get the Investing Masterclass and Market Briefs all for free, all you have to do is sign up, and I have the link for you down in the description below. Number 1 is changes in the SALT cap. So this is for those of you that are homeowners, especially if you live in a high tax state. That is California, New York, New Jersey, Connecticut, Illinois, Massachusetts, other states that have high state taxes. You definitely want to pay attention to this. SALT stands for state and local taxes. And the idea here is if you own a house, you have to pay property taxes. On top of that, if your state charges you a state tax, you have to pay that. And if you have other local taxes, you have to pay those as well. And before 2025, before this tax bill was signed, the most of a deduction that you could get for the state and local taxes and your property taxes was up to $10,000. Which is why many people said, you know what, the SALT deduction does not mean anything. I am just going to take the standard deduction because the standard deduction, which I just talked about, was going to give you a bigger tax write-off. Well, through this new tax bill, the SALT deduction changed. It is no longer $10,000. It has gone up to $40,000. So you can add up your property taxes, you can add up your state taxes, add up your local taxes, and now you can take a write-off of up to $40,000 a year from your federal taxes, which can be more than your standard deduction, which means you have the ability to get a bigger tax write-off. But there is a couple nuances that you need to know. In order to qualify for the full $40,000 deduction, you have to be making under $500,000 a year. But this is an opportunity for many people now to opt out of the standard deduction and get a bigger write-off through this itemized deduction by qualifying for the SALT deduction, assuming you are paying high property taxes, high state taxes, and/or high local taxes. If you, your parents, or your grandparents are over the age of 65, well, now you qualify for an additional $6,000 tax write-off. Why? Because you are a senior over the age of 65, and that is it. But to qualify for this additional $6,000 tax write-off, you do have to meet a couple income requirements. If you are a single tax filer, you have to be making under $75,000 a year. And if you are married filing jointly, you have to be making under $150,000 a year. And to clarify, this $6,000 deduction for seniors is on top of the standard deduction that everybody gets. Number 3 is a little bit different because this one is not directly from the Trump tax plan. This is from a tax plan that was signed back in 2022, and it went into effect on the 1st of January 2026. And what this says is if you are over the age of 50 and you are a high income earner, you can qualify for a higher contribution into your retirement accounts. But there are some qualifications you have to understand and some changes. In 2026, if you want to put money into your retirement account, more specifically your 401k, there are limits to that. And in 2026, it is $24,500 a year, which is the max you can contribute to your 401k. Well, if you are over the age of 50, you can add a little bit more. It has the ability to catch up as you get older. That way you can plan for your retirement. So if you are over the age of 50, you can add an additional $8,000 a year into your 401k. If you are between the ages of 60 and 63 and you are really trying to catch up, well, now you can add an additional $11,250 a year into your 401k, which means as you get older, if you are trying to play catch up, the government is going to allow you to add more money into your retirement accounts. But there are some new changes that you need to understand. If in 2025 you made over $146,000 from your job, well, that catch up contribution cannot go into a traditional 401k. It must go into a Roth 401k. The difference between a traditional and a Roth 401k is with a traditional 401k, you do not pay taxes when you put the money in. You pay taxes when the money gets pulled out when you retire. With a Roth 401k, you pay taxes as soon as you put the money in. But then when you pull the money out, you do not pay taxes. So here, if you made over $146,000 from your job last year, you must put it through a Roth 401k. You cannot do a traditional 401k. That is the first change. The second thing you have to understand about that is some companies will not offer a Roth 401k option, which means if you are trying to do this catch-up, your company does not do a Roth option. You might not be able to qualify for this catch-up bonus tax rate. Number 4 is that you no longer have to pay taxes on tips as long as you qualify. Between the years 2025 and 2028, you can qualify for a $25,000 write-off from your tips. So if you are a waiter/waitress, you are a bartender, and you are making tip money regularly, you can take a $25,000 write-off. So it means you can get up to $25,000 worth of tips and not pay any money in taxes. As long as you qualify on the income requirements, which means you have to make under $150,000 a year as a single tax filer or $300,000 a year married filing jointly to be able to qualify for this $25,000 write-off from your tips, which allows you to make up to $25,000 in tips and not pay any money in taxes. And last but not least, rule number 5 is no more taxes on overtime for hourly workers. If you qualify, What this rule says is that if you earn overtime income, you do not have to pay any taxes on that overtime income. If you make under $12,500 in overtime, if you are a single tax filer, and up to $25,000 of overtime income. If you are married filing jointly, over this amount of income, now you're going to have to pay taxes on the overtime income, but you still have to meet the income requirements to qualify for this. No taxes on overtime. You have to make under $150,000 a year as a single tax filer, or $300,000 a year married filing jointly. If you are an RIA or financial advisor managing real money, and you would like my firm to help you with your research to identify better investment opportunities to increase your assets under management to keep your clients, or get more clients, I invite you to apply for Briefs Advisor Pro. This is our enterprise-level research for financial professionals, so if you are an RIA or financial advisor, you are managing real money, and you want to see how our firm can help you achieve better results, I invite you to learn more and apply for Briefs Advisor Pro. If you are interested, I have a link for you down in the description with a short video that will explain more about what Briefs Advisor Pro is. So what we talked about in this video is that in 2025, President Trump signed the biggest tax cuts in the history of America, called the One Big Beautiful Bill Act. And the first thing that did is it changed your income tax requirements, and it also changed the standard deduction requirements, because those were set to change come the 1st of January 2026. But because this One Big Beautiful Bill Act was passed, most people should be paying less money on their taxes because of the changes on your marginal income tax rates and the standard deduction rates. We also talked about how our tax code is designed to benefit investors more than employees, which is why you should work to be an investor. Again, I have my free investing masterclass and market briefs for you down in the description. So if you haven't signed up for that yet, again, I have the link for you there. And then we talked about 5 other provisions that you want to pay attention to. The first one we talked about is the SALT cap. This is now your state and local taxes and your property taxes. Before, you can only write off up to $10,000 a year. Now you can write off up to $40,000 a year, which gives more homeowners, especially in high tax states like California, New York, Massachusetts, and Connecticut, and New Jersey and Illinois. It gives you the ability to now qualify beyond just a standard deduction. Number 2 is a senior bonus. If you are over the age of 65, you get to qualify for an additional $6,000 deduction just because you are over the age of 65. And this is on top of the standard deduction. Number 3 is the Roth catch-up change. What it says is if you are over the age of 50, you can contribute more money to your 401k. If you are over the age of 60, you can contribute even more money to your 401k. But now with this new rule, which started in 2026, if you are going to do this catch-up into your 401k, it has to be a Roth 401k. It can no longer be a traditional 401k. So if your company does not offer a Roth, talk to your HR representative, talk to your company to see if there are any alternatives. Number 4 are no taxes on tips. What we learned is that through this new bill, you have the ability to not pay any taxes on tips, assuming that you meet the income requirements and how much money you are getting from tips. And then finally, number 5 is no taxes on overtime income, which means yes, if you meet the income requirements, you do not have to pay taxes on your overtime income so long as you are below the threshold. Now, if you got value out of this video, the best thank you is a referral. So if you could please share this video with a friend, family member, colleague, or fellow investor, that way we can continue to spread this type of financial education. Thank you, President Trump. Just signed an executive order creating a new way for Americans to retire in the United States. It is not going to be with a 401k, it is going to be with a Trump IRA. Take a listen. Every American, most high-income people have an employer that gives them a 401k with a match, but low-income people or Uber drivers or something, they do not have access to a retirement plan. Well, that is all changing right now because this new Trump IRA is going to be open to everyone regardless of where you work or how much you make. And the best part is that the government is going to match your contributions up to a certain percentage, even if your boss does not. This is a game changer for the working class and for people who have been left out of the traditional retirement system for far too long. I am talking about millions of Americans who now have a real shot at building wealth for their future. But you have to understand the rules, because if you do not follow the steps, you are going to miss out on the match. And let me tell you, free money from the government is something you never want to leave on the table. So here's how it works. You open the account and you start putting in whatever you can afford. Maybe it is $50 a month. Maybe it is $500. The point is to start. Because the power of compound interest is the 8th wonder of the world, and the sooner you start, the more it works for you. The older you get, the more you realize that time is your most valuable asset. Do not waste it. Start building your simple life and your wealthy life today. We live in a world that thrives on your confusion, but I am here to tell you that it does not have to be that way. You can take control of your finances and your future by simply paying attention to the details. The tax code is a map, and if you know how to read it, you can reach your destination much faster. I am here to help you read that map, so keep following along, keep learning, and most importantly, keep taking action. Because knowledge without action is just trivia, and trivia does not pay the bills. But action combined with knowledge creates wealth. And that is what we are after. Real wealth, real freedom, and real peace. So stay focused and stay disciplined. The journey to financial independence is a marathon, not a sprint, but every step you take brings you closer to the finish line. I am proud of you for being here and for taking this step. Now let us go out there and make it happen. Remember, the best person to take care of the old you is the young you. Do not let them down. Keep it simple, keep it consistent, and watch the results follow. I am DDO8, and I am here to see you win. Let us get to work. Every single dollar you save in taxes is a dollar you can put to work in the market. And over time, those dollars turn into a mountain of wealth. That is the secret. It is not about making millions overnight. It is about keeping what you earn and growing it steadily. So take these tax tips, use them, and share them with someone else who needs to hear this. We are building a community of savvy investors who know how to play the game, and together we are going to change the financial future of our families. Thank you for watching, and I will see you in the next video. Stay smart, stay savvy, and stay wealthy. Peace out for now. See you soon. Goodbye and good luck. Success is waiting for you on the other side of your effort. Go get it. The world is yours if you have the courage to take it. Believe in yourself and your vision, and never let anyone tell you that you cannot do it, because you can and you will. One step at a time, one day at a time, $1 at a time. That is how it is done. I am gone for real this time. Bye.